Back for part 2? Friar's episode covered the 3 traditional main asset classes, equities, bonds and cash. But did you know there's so much more to the asset class mix? That's right, this episode of BlackRock Basics is an intro to alternatives. So, before we get into alternatives or alt, I thought it would be useful to have a little recap on what asset classes are.
Asset classes are a group of financial products that act in a similar way and are affected by the same laws and regulations.
Move, bruv. Each asset class has different investment characteristics, including the level of risk, how much is an investor willing to accept to get a level of reward, the return, what is the investor's potential return from the investment, time horizons, over what period is the investment expected to deliver the return, and how they tend to perform in different market conditions. For example, could changes in interest rates or inflation have any impact on their value? Alternatives are asset classes that do not fit into one of the traditional investment categories. This means they aren't publicly traded equities, bonds or cash. Simple, right? But they are a very diverse asset class that cover a wide range of investments, including infrastructure. These are things that impact people's daily lives, such as hospitals, airports and toll roads. Private equity. So, instead of trading shares in a publicly available company, investors may choose alternative avenues to put capital into private companies. Private credit. Investors can provide loans directly to businesses and sometimes individuals as an alternative to traditional lenders such as banks. Real estate. This is basically a fancy way of describing investments in property or land. Have you ever watched one of those TV shows where it follows an estate agent showing luxury properties? Well, on the other side of those deals are investors looking to benefit from either rental income, so it is not the investor's primary residence, or capital gains, which in this case would be an increase in the property's value realised when the property is sold, and sometimes both. As well as residential properties, there is also commercial real estate, which includes things like retail stores and office buildings. So yes, you can also own your own skyscraper. Commodities. Commodities are raw materials like gold, wheat and oil. Investors typically purchase these materials because there is global demand as well as real-world use. Collectibles. More than just a hobby. Think arts, antiques, classic cars and even comic books. These items may be old and rare, but have developed worth over time. Digital assets. Generally speaking, a digital asset is anything that is created and stored digitally, is identifiable and discoverable, and very importantly, has the potential to create value in a way that generates returns for their owner. There are many types of digital assets, such as photos, music, animations, manuscripts, and more. But the even newer types of digital assets that are based on blockchain or similar tech include cryptocurrency, tokens, non-fungible tokens, aka NFTs. I hope you didn't think I forgot to explain what blockchain is. Blockchain is a kind of database that shares data, but unlike a normal database, it organises and stores data in blocks, connected by cryptographic methods. So what's the difference between alternative and traditional assets? Well, firstly, alternatives tend to behave differently than traditional equity and bond investments. They rely less on the markets, and by this I mean that these investments are potentially able to hold their value even during a recession. Alternative assets also tend to be quite illiquid, meaning they are not as easily sold or quickly converted into cash, and this is especially evident when we compare them to traditional assets. Let's think about collectibles for a second. Now imagine you have Heath Ledger's film-worn costume from The Dark Knight. Do you think it would be quicker to sell the costume or its equivalent value of shares in a popular technology company? I'm going with the shares. Why? Well, it's likely that the market for buying the costume is much smaller because, it's kind of niche. You'd probably need to authenticate the costume firstly, find an appropriate auction house with a history of selling this type of product to interested buyers, and then you need to list it at an appropriate time, perhaps when a reboot of the film is announced, in order to realise its full market value. Now, compare this with the millions of investors who would be interested in buying the technology company shares and the way they would go about it, for example, through an online brokerage. Alternative assets tend to be held by institutional investors or high net worth individuals when compared to traditional assets. This is due to their more complex nature, meaning they require more understanding of the asset and its market. Alternative assets also have the potential to create greater returns when compared to traditional assets. This is usually because alternatives are sometimes considered as riskier investments and tend to be illiquid in nature, so investors look for greater compensation for taking on these risks. Alternatives also come in lots of forms and structures, which can be great for helping investors choose the investment that best suits them. This can be in terms of the investor's risk appetite, time horizon, return requirements, and wider investment goals. Alternatives are becoming more and more available to different types of investors and a big part of the investing landscape. They can be a powerful tool for investors to create more resilient portfolios by diversifying from traditional asset classes and increasing potential returns. But it is important to emphasise that this higher return potential means that they are often riskier investments. So, there you have it. If you enjoyed this video, you already know what to do, and we'll see you on the next one.